Ladies and gentlemen, welcome back to the channel. We have Meta moving higher in the after hours by almost 5% and AMC reversing the losses that you've seen intraday for the most part. AMC stock closed regular trading down about 1%, up around 0.5% here in after hours. Now let's go through the latest data. Let's talk about what the Fed said, because the Fed is the big reason why AMC did reverse. But on top of that, I think it's important we talk about the economic data coming out tomorrow morning as well. So let's get into it. I hope you are buckled up. I hope you're ready to go. Ladies and gentlemen, hit the like button and subscribe to the channel if you have not done so already. So first things first, let's start with Meta earnings, because why not? That was the first thing we opened the video with. We might as well go ahead and talk about it. So Meta's a tricky bugger, you know. Reported an 11% jump in revenue and issues optimistic guidance for third quarter. I'm honestly surprised Meta's only up, in the mid 4% range now in after hours, because their earnings themselves, incredible. Guidance was stellar. You couldn't have asked for something better. I guess it could always get better, but maybe I shouldn't say it like that. It was better than the average analyst expectation by quite a bit. So Meta's guidance is really what caused the stock to rocket up almost 9% at one point in after hours. And then it fell because of a very specific reason. Now, Meta said third quarter revenue will be between $32 billion and $34.5 billion. Analysts polled before the report were expecting third quarter sales of $31.3 billion. So, even on the bottom end range of guidance, Meta said they're going to do $700 million more than that. Up to, $3.2 billion more on the higher end range. The guidance was huge. Massive. Usually analysts are not this off on the actual guidance number that you get. So this is kind of a weird anomaly. Daily active users, 2.06 billion. Yeah, you motherfuckers be using Facebook, huh? Versus 2.04 billion, which was expected. Monthly active users, 3.03 billion versus 3 billion expected. And the revenue per user was $10.63 versus $10.22, which was expected. Now, why Meta is important? Let's highlight this. Meta is important not because it's Meta or it's Mark Zuckerberg. Who cares about any of that? Most people aren't very fond of Zuck anyways. Why is it important? Because big tech earnings were the single biggest catalyst that could have negatively affected our markets. Beyond even the economic data, beyond the Fed, earnings was the thing most likely to negatively impact our markets. But specifically your big tech names. Nobody gives a shit what happens to Crocs in the morning or what happens to Roku tomorrow and after hours. But Meta, Apple, Amazon, Microsoft, Tesla, Google, these names, that's what moves the broad indexes. And so far, Microsoft, Google, and Meta reported pretty good earnings. They all beat expectations, top and bottom line. So there was not a single miss so far in big tech land. Tesla as well smashed earnings estimates. So earnings came in better than expected across the board. The thing that is really determining if these stocks are going higher or not is their guidance. And what we've seen so far is guidance has been pretty good. Microsoft dropped 3.5% today because they gave us a little bit weaker guidance than what we were expecting for their cloud computing program, Azure. Nobody gave a shit. Microsoft fell 3.5%. That's nothing. Who cares? Everything else has done well. As far as the actual earnings, I know Tesla fell. I know Netflix fell as well. Nobody even cared because the earnings themselves were good. It helps support current market valuations. And this is not the only thing that could bring down the markets, But it's the thing that was most likely to bring down the markets, if anything was going to. Economic data, sure, that can bring down the markets, but economic data has been so good lately, odds are you don't get a one-off report that signals imminent recession. That's very unlikely. If that happens, boy, you're in for a problem, potentially tomorrow morning. And this could be a good problem if you're in AMC, if you're hoping for a short squeeze, things of that nature. So don't get lost in the sauce. And, if I say these things are good, I mean for the broader markets, not necessarily for AMC. Now, if things get bad, well, that could happen tomorrow morning with some of the data that we're going to get. But first, Fed Jerome Powell, because Fed Jerome Powell is a little bit more important than I think even the economic data for tomorrow. Fed Jerome Powell, what he said, well, the first thing that he said that caused the markets to rally is, let me paraphrase this. He was asked essentially what would need to happen to get the Fed to pause, or maybe do a hike every other meeting, or how their policy ahead is going to be based on inflation being at 3% right now. Fed Jerome Powell said a lot of the same old, that we're not going to commit to pausing or raising rates. We're going to let the data kind of dictate that for us. But he said something specific. He got a little more specific. He said the next Fed meeting is not for 8 weeks. That means we're going to get 2 CPI reports, 2 labor market reports. We're going to get basically 2 of everything. So he said, based off of that, we might pause or we might raise. And I think it was an algorithm kind of thing. When Fed Jerome Powell said pause, that's when the market started to go higher. Or we might pause, specifically those couple words, that's when the markets started to move higher. That's when AMC, at the same time, started to also move higher from this sell-off that we had seen from the beginning of the day. And it was basically a continued move higher throughout the rest of the day after Fed Jerome Powell said this. Actually closing higher than the highest point during the rally in the press conference. That was about $5.07 per share. You closed at $5.09 per share here in after hours. So this is positive, just in terms of interest rates falling, in terms of capital becoming a little bit less expensive. Like, take for consideration, if this court proceeding does not go as AMC hopes it will, if the judge says AMC cannot go through with this reverse split and do this dilution, well, they're going to have to raise capital some other way, likely in the bond market. And based off of how treasuries react and how the Fed, goes about Fed policy, that's going to dictate how much they have to pay in interest payments, because that's the next likely course of action. Now, this had an immediate effect, not a huge one, but a sizable one, on the 10-year Treasury as well as the 2-year Treasury. The 10-year Treasury dropped 4.5 basis points to 3.86%, which it's been pretty flat now for like a year. So, you just, when this thing breaks out or falls down, breaks down, I should say, that's where things are going to get a little bit more important. But you didn't see a skyrocketing of bond yields. That was good. 2-year Treasury fell almost 4 basis points as well. This one has been rising recently. So to see a fall here is a little bit more encouraging. And this is more short term. So markets are not convinced of a pause at the next meeting. It's about 50-50. So the economic data is going to be very important. Now, why? Obviously, I just said why this is important for AMC. But at the same time, what does this do for the broader markets? Well, your technology names, your stable names that are not really growing, like a Microsoft or a, Apple, to a lesser extent, a Google or an Amazon. Well, when interest rates fall, there used to be this saying called TINA. There is no other alternative. That's the saying. And that was the saying when bond yields were, 0.5%, because there was no other alternative than to be invested in growth. Well, what you've seen is there is an alternative. It's bonds. It's called bond land. So a lot of investors don't want to touch long duration growth right now. But if they need to be in stocks, they want to be in your Apples or your Microsofts. They want to be defensive. And that's where a lot of money is. So once that shift actually starts, you're going to see a lot of money flow back into your small and mid-cap stocks. That could benefit AMC much the same way as you've seen today. That was money flowing from big tech into places such as AMC. Small and mid-cap stocks, your unprofitable stocks, your long duration growth stocks. That's what we could expect to see. So even just on top of AMC and a potential short squeeze for any of you guys that are investing, that's probably, that's how I'm positioning my long-term portfolio, is for this switch of eventually when the Fed does start to cut rates, bond yields fall. The lower these bond yields go, the better it's going to be for small and mid-cap stocks. The worse it's going to be for your big tech names. Now, I don't group Netflix, I don't group Meta in that, I don't group Tesla in that. I think those stocks are a little bit different. They are growing. They're growing more than an Apple or Microsoft, right? Apple, Microsoft, Google, Amazon, those are the guys you would probably want to steer clear of if interest rates do start to fall. Keep that in mind. Now, as far as AMC specifically, cost to borrow fees sitting at about 263.5% over here from Interactive Brokers. Cost to borrow max 400%. So the data is not too changed from the report that we gave you guys earlier. 29% short interest. Official reports have this at the highest it has been at in this cycle. And I think the main story that you can get out of all of this, hedge funds and institutions continue to do the same losing strategy that they were doing this whole time. Today, you've seen 62 option trades totaling $8.87 million, positive order value of 6%. Hedge funds, institutions are not hedging out risk here. $9 million worth of options could hedge out a lot of risk in your short positions. Instead, they're just using the options as more leverage to short AMC. What they should be doing, if they were focused on a risk management kind of strategy, is say, hey, we have a massive short position. Short interest of free float is likely over 100% because these damn apes own 80% of the float still. We should take some money, put it into options to hedge out our short position, just in case more big green days come. We don't lose our ass in these short positions. But they're not doing that. This ultimately only ends one way for the hedge funds and institutions. One way, that's it. The mother of all short squeezes. Yep, you heard that correct. So, in a weird way, the more bearish the charts get, the more bearish, the option flows get specifically, the more bullish you should be. Now, tomorrow morning, you're going to get a couple important data points. 8:30 in the morning, you're going to get durable goods orders month over month for June. You want to see good economic data to see the markets go higher, to see your small and mid-cap stocks really outperform. If your economic data starts to come in bad, very recessionary, you're not going to see money flowing into sectors like AMC, right? Your small and mid-cap stocks not going to do well. During the last place you really want to be is stocks that have a lot of debt that would be hard hit during a recession. Kind of the last place you would want to be. If you had to be allocated in stocks, you probably want to be in healthcare, your stable companies, your big tech names like an Apple or Microsoft. So you don't want to see durable goods orders fall by quite a bit. Expectation is 1% positive. If you come in line with that, great. If you come in higher than that, fucking perfect. GDP growth rate, quarter over quarter, advanced data for Q2. You're expecting this to come in at 1.8%. You're expecting GDP price index quarter over quarter to come in at 3%. The higher, the better. The higher, this is just really the less chance of a recession ultimately, right? Because recession is 2 consecutive quarters of negative GDP. We had a recession in the beginning of 2022, a technical recession, 2 down quarters of GDP growth. So you want to see that steer clear of being negative. So those are going to be big catalysts coming out tomorrow morning that could also affect our markets. But ladies and gentlemen, that's going to do it. I think that's really some big information that you needed to know here in this video. Meta still up about 5%. The earnings call, I think, is going to be quite volatile once we get more clarity on, Reality Labs. That was the big thing that kind of sent the stock down from that 9% rally, was they expect Reality Labs to lose more money this year than it did last year, and that was the whole reason why Meta dropped in the first place last year, which is a real head scratcher. And they also expect payroll to increase after they've been laying off a lot of workers. So some head scratchers there, but some overall good numbers. So that's going to do it for this video. Obviously, with AMC, like we said in the last video, it's going to be volatile. Expect that. This is to be expected. Today was a relatively flat day, obviously. Down a little bit, not a huge deal. Odds are the next couple days could be big up days. Again, not a big deal until we actually see shorts covering, until we see some of that option activity turn to actually calls, to get a better read through on how hedge funds and institutions are actually playing this trade. Well, that's when, we're going to have a little bit more clarity. But right now, none of this shit matters. So hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, link down below in the description of this video as well. You guys enjoy the rest of your day, and I will see you in the next one.